Hey, this lecture we're going to finish up chapter 3, and in a sense we're going to be finishing up the accounting cycle with all 7 steps that we will have covered. So the first thing, if you want to get out the notes, I have further notes here in module 2, chapter 3 notes. I have it broken down into the 2 sections. Our first lecture before was over the part 1 with the adjusting entries, and now we're going to move in here to part 2. We're going to still be looking at the Dr. K example, but just with the answers now, with the adjusted trial balance answers, and we're going to be working off of that. You may have already got the answers from when you did it up in the previous lecture, but I have them here just in case you didn't. So what we're actually going to do, instead of in the past, what we've done is had part 1 lecture, part 2 problem, and then part 3 doing the connect. We're actually going to do part 1 and part 2 together. We're going to do the practice kind of right along as we go through with the notes. All right, you're going to want to have the notes. We're going to look at our notes, and we're going to have the adjusted trial balance from Dr. K. So this is Dr. K's adjusted trial balance. What you're going to see, so let me review the 7 steps that we kind of have covered in a little bit of a different order, but eventually we are getting through all of them. We did these like a couple lectures ago. We did the T accounts and journal entries. The most recent lecture, we looked at the adjusting entries going into the adjusted trial balance. Adjusted trial balance is simply just the most up-to-date trial balance that we have possible. We're going to kind of cycle back to the financial statements today by doing them and then closing out everything. And then today we are doing the closing entries, the final steps that actually get us ready to go into the next year. So these close out the certain accounts that need to be, but not everything gets closed out, as you'll see. Okay, so for closing entries, the easiest way to remember what accounts get closed is the acronym RED for revenue, expenses, and drawings, or dividends, either one. Those are the 3 items that get closed. And where they get closed to is essentially, in a sense, they get closed to retained earnings. But the book, how it does it, it likes to close everything out into a very temporary account called income summary, and then close things to retained earnings. That's just how we'll have to do it, since that's how the book does it. It's not an essential step that you have to go through income summary, but for the homework problems, you will. So the items that stay are pretty much everything in the bare bones accounting equation, except the dividends. They go. Everything out here gets closed out. These revenue and expenses will eventually move into one of these 2 categories, into the income summary. I added this one. Your T account won't show this, but you can easily add one. You can put it down here if you want in the underneath the revenue section. But it is a owner's equity. But then you'll find that this income summary, it gets closed out right away and eventually goes right into the retained earnings. So what's the purpose of really having an income summary? There's not much of a purpose to having it, but that's how this this section does cover it. So we will do it the same. All right, so the items that get closed out, those are considered our temporary accounts, our revenue and expenses, and our drawings. And then that income summary is really temporary. Now, when you think of closing entries, think of the acronym RED, and then there's just 4 easy steps to close out the entries. You just simply close out your revenues, income summary, close out your expenses, step 2. So now we're in the E for R, and then E, close out the expenses to income summary. Then total up your income summary and then close it out to retained earnings. And then finally close your dividends to retained earnings as well. Everything gets put into that retained earnings account. It's a summary of where the business is at, how much money the business has earned and still retains after paying out all of the money that it needs to, or all the after at least accruing all of the expenses that it has done. So you can kind of see here in I tried to make a little diagram, close out the revenue to income summary, close out the expenses to income summary, then close out income summary in here to the final retained earnings, and then close out our drawings into the retained earnings as well. Okay, we'll be right back. So I think the best way to just put this into practice is to go ahead and let's try closing out our Dr. K. So if you would pull up the best way to practice this is just to go ahead and pull up this Dr. K. And what I did in addition is I didn't put them all in here, but I put a few of the balances, especially the ones we're going to close out, starting with, and I'll go ahead and probably put in the drawings, but I started here with retained earnings. I put the $7,000. I'm going to scooch this over just a bit. So I got the $7,000 in here for retained earnings, and I've got the $9,500 for sales revenue. And then just to sample how the expenses go, I put in the first two. Once you do the first two, the rest go just the same. So there was really no need for me to go ahead and put them all in. But I will go ahead and put in the dividends here of $4,000 debit. Now we're ready to close out our items, our accounts that get closed, and see how that works. So what I'm going to do is open up this new sheet, and these will be our closing journal entries. Closing journal entries are always at the end of the month, usually at the end of the year, more likely. So let's get into it here. We need to debit. So if we have a debit column, and then we have a credit column for our debit credits and our accounts. So the first item we're going to do is go back to our 4 steps. We're going to close our revenue into the income summary. Now the income summary, remember I also added that. That goes right below your retained earnings, or you can put it right here below the sales discount if you don't have enough room. Income summary right now is nothing. There is no income summary on our T account or in our trial balance, and there shouldn't be. We're never going to have income summary on our books for more than just a few minutes, because we're going to put stuff in and then take it right back out. So with our first thing we want to do is we want to get this account to 0. I want to get the 9,500 down to nothing to start the next year. I want to be at 0 for next year. So the only way to do that is to put it over here as a debit. So I'm going to debit 9,500, and then when I'm ready to balance, my balance is going to be 0, and that's what I want it to be. But I can't just put this debit here and then not do anything with it. I have to balance it out somewhere, and where we do that is in our income summary. So I'm going to put 9,500 over here in the income summary as part of a closing entry, and that's kind of what I would put here as my date. I would simply say closing to show that that's what's going on. And usually we'll never have anything over here in the no column, except for the closing. To get it down to 0, we have to do that. So my journal entry, I would debit my revenue account for the 9,500 and credit the income summary for 9,500. That's our simply our journal entry number 1 in our closing entry. So if we wanted to keep track, there's only going to be 4 of them. Journal entry number 2. We're ready to go into to close out the expenses to the income summary. So if we look at my T account, my T accounts show my expenses, and they're where they're supposed to be on the debit side, just like the trial balance shows. Now I'm ready to close those out, and the only way I can do that is to credit them. So I'm going to do it to 2 of these, and then we'll just kind of combine all the rest just to make it a little quicker here. So we're going to close out this account, credit 2,100. I'm going to close out this account for 5,000. And then we would close out the rest And then what we're going to do, and I don't need to put each one of these amounts into the retained earnings. I'm just going to summarize all of them and put it in as one combined amount. So let's go ahead and do that. Our journal entry is going to be, actually, we're going to debit our income summary. And the debit amount, well, we actually could know what it is. But technically, if we wanted to do this the long way, we don't really know what it is yet. And we won't know until I insert all of the credits that I just did in my T accounts. And so I would come through and I would debit or credit my interest expense to get it to 0. And then credit my depreciation expense to get it to 0. And then you'll see what I'm going to do here. I'm just going to put remaining expenses, just so I type them all out. And if I total up the remaining, it shows it's $8,700. And then simply I need to come over here and debit all 3 of these. And that's going to be what my income summary is. My income summary is going to be a debit of $15,800. So I can come over here now. I've gotten rid of all of my expenses. They're all balanced at 0. And my closing entry, I'm just going to reference it so I don't type it in wrong. 15,800. And this is, think of this just like our owner's equity. This is a minus and this is a plus. So as you can see, right now, this account has a negative balance. And this and retained earnings are the only 2 accounts where you can have a negative balance and it's okay. That doesn't mean you did anything wrong. That simply means that the business isn't doing well. The business has more expenses than it does revenue. It's not a good thing, but it doesn't mean you did the accounting wrong. So our balance, our temporary balance, is simply going to be the 15,800, the higher number, minus the 9,500. So right now we're at a negative 6,300. We're losing money. So when we were doing if we were doing the income statement, we would have a net loss at this point of 6,300. Net loss, obviously not good. Okay, so we have a balance of 6,300. I can't leave that there. The income summary also has to be closed out. So I'm ready to then go ahead. I'm going to get 2 more lines in here. So we have room. We are going to close out as closing entry number 3, this amount. So I'm going to come over here and credit my income summary if I have a loss. If I would have a normal income, then I would have come over here and debited the amount. So it's just whatever is opposite of where you're at. We have a closing credit here. And if I go back to my notes, I close out the income summary directly into retained earnings. So let's do that. We're going to credit my income summary. So then I'm going to come up here, and as a closing entry, I'm going to put 6,300. And remember, this is a minus, so I'm actually taking away from my overall earnings over the entire life of the company. So that's not a good thing. So I come over here to do my number 3. And in my journal entries, I had debited retained earnings. That's never a good thing. We don't like to debit retained earnings because that means we're losing money. Debit the retained earnings for the 6,300. And then the credit was to income summary. 6,300. So what that does now for our income summary, we are now at zeros. We have no balance. We are ready for our last item to close out, and that's simply to close out our drawing or our dividends. And those get closed out directly to retained earnings. So my retained earnings, we're going to look at, well, let's first look at our drawings. My drawings, I took out 4,000 throughout the year. So to get rid of that, I need to credit the 4,000. And if I credited the 4,000, that means I need to come over to retained earnings and debit the 4,000. So let's go ahead and do our journal entry. We're going to debit retained earnings. That's what we did in our T account for that forbearance. Credit the dividends. So now I have done all 4 steps of the closing entries. They're not that hard. They're not that difficult. It's just something that has to be done because we've got to get these accounts to 0, but we can't just ignore those numbers. We got to put them somewhere. And where they go is our ending balance of retained earnings. So my ending balance, we'll put in our order here, and we actually will have a negative. This company is actually in the hole overall. We've paid out more money or expensed and withdrawings and everything else more than what we've made. So this company is not doing real well right now. But we still, so we're gonna take this plus this and then subtract out our credit. So we have a final balance. Remember, we never have negatives in our T accounts. Where they're at tells me it's a negative, so I don't show it as a negative. I just put it as a $3,300 debit balance, which for an owner's equity account is not a good thing. Okay, now what that leaves us is we are ready to make our post-closing final trial balance for the year. As you can see, that's our final step. We've done everything. We've closed out the accounts. We've gotten them ready for next year. Now we're just going to show all of the accounts that are still left with their balance. And the best way to do this is I'm going to bring back up this guy, our opening, and our post-closing trial balance. You're going to see that it is very, very similar to this. So I'm going to actually just copy and paste it straight over, with the biggest difference being that everything after retained earnings is gone. So that's one difference. Don't need to put anything after retained earnings. Then the other thing that I need to do is I need to get rid of my drawing account because it's also gone. So I'm just going to move up my retained earnings and get rid of the drawing. Because if you remember, I didn't do anything with cash. Nothing in our closing entries did anything with cash, nor any of the other assets. They all stayed the same. I didn't do anything with my liabilities. And I also didn't do anything with my capital or common stock account. Nothing happened there. The only thing that did change was this number. My retained earnings is still not 7,000 anymore. So I need to get rid of that. And and I need to then go to my T accounts. I need to use this brand new ending balance, $3,300. $3,300, remember that was on the debit side. It's not good. It's what it is. Retained earnings has a $3,300 debit balance and negative. Most of the problems that we do in class won't have a debit balance. The company will still be in the positive, but this company happened to not be. So then we can go ahead and total up everything we have for the end of the year, and our goal hopefully is that everything will total just like a regular trial balance does, that the debits will equal the credits. So we will check that at this point. Total up all of my debits, knowing that the expenses, drawings, and revenue are gone. Total up all of my credits, and let's see if we are good. Look at that. There we are. We are good. 61,200. is our final debit and credit totals. That's how, and of course I would call this not the adjusted trial balance anymore. We would call this the post-closing trial balance. This is the trial balance that I would use to then go into the next year. These are the T accounts that are left and the ones that should have balances going starting January 1.